Hi everyone, I'm Jeremy.
And I'm Damien.
Welcome to our Suburb Data podcast, where we cover everything from property investing to expert busting.
If you're new here, we share our personal and professional experiences from 23 years in the game. So you skip the mistakes we made and go straight to property investment success. And today we're going to be discussing how to analyze a property market. And I think my inspiration with this is one of the earlier videos that I heard where you featured, Jeremy. So it's actually, I know I've mentioned Ryan McLean before on property. I've never met him, but early on in my days, I was listening to his podcast and I loved the fact that he was quite down to earth. I learned a lot, and that's how I heard about Jeremey Sheppard. And do you remember
Ryan really gets to the point. He just wants to know the truth, and like you said, very, very matter of fact. And how do we use this information to make better property investment decisions? So really good interviewer. It was a great interview.
I loved his honest approach and not markety. I haven't reviewed a lot of his videos, but in the earlier days, so I found a bit of inspiration. So I came across one of the videos that I will bring up on the screen just to sort of bring up the Jeremey Sheppard from 8 years ago. And we got Ryan, so apologies for the jazz of the earlier days, the hairstyle, but looking pretty good.
At least it's not so grey there.
Let me hit play. Let's just hear the guru.
My emotions out and prevents me from making subjective decisions. But the other issue was that I wanted to buy in the best places in Australia, and there's like nearly 16,000 suburbs. So how do you go about filtering that down? And having an automated tool that just zips through all of them, looking for at least some positivity in certain statistics, that to me, it just struck a chord. And I found myself gathering the same sort of data all the time for individual suburbs. Thought, why can't I just do it for all of them?
Yeah.
And so that's where.
So how do you decide on the criteria to say, well, I'm going to?
So that was a bit of an intro. So I'm going to leave a link to the video in our description, so anyone can review the older video. But I'll be asking very similar questions, a little bit updated, but it's I just thought it was great to sort of re-review that, and I'm going to ask some hard-hitting questions today.
I hope I give the same answers.
Well, it's good. Anyone can go back and listen to the old video and the new, and they can, are you happy to take that approach? And this is just not much preparation, is it really for you? You're just going off the cuff.
Yeah, I wouldn't mind reviewing what I said on that video before, but okay.
All
Far away.
So how did you get into property analysis?
I know the answer to this. I obviously wanted to buy in some of the best areas in Australia, and I didn't know originally what I was looking for. Penny dropped one day that it's supply and demand that pushes prices upwards, and I thought, how can I get information, data of a supply or demand nature, and then munge that together in some way to give me, it ended up being an overall score for each suburb. But it was, the penny dropping moment was supply and demand.
Initially, like me thinking about it, it was like, okay, these data points, how do you know what impacts supply and demand?
Yeah, well, back then I didn't know. And I was really just going off my own experience in property investing at that point in time. So I knew that if a lot of people turn up at the open inspection, that means there's more demand. If there's hardly any properties for sale, I know that means there's limited supply. If there's a high auction clearance rate, I know what that means. And so I was just interpreting what is going on here for this particular metric. What's this data telling me about the nature of either supply or demand, or maybe a bit of both? So I was really guessing in the early years.
Because when I first heard about it, I'm like, this is great, like a shortlisting tool to find suburbs really quickly. But I was like, okay, and I've mentioned this to you a lot about, are there certain metrics that have more weighting to the demand to supply ratio score?
Yeah, there definitely are. Some are less effective. They correlate to capital growth less than others. So, there's a different weighting. Yeah.
And to give everyone a background, you were working a full-time job and you created this effectively shortlisting tool?
Yeah. In my spare time, weekends, after hours, that sort of thing.
How do you start? Like, it's just like, okay, pen and paper. How does it all come together?
I guess it started. I had an interest in a particular suburb, and I wanted to know what I'd heard about it. Is it actually that good? So I would gather a few metrics for that particular suburb, and then think to myself, well, is it good or isn't it? I don't know, because I've got to compare it to other suburbs. So I might look at half a dozen and think, oh, yeah, this one's the best. And then I realise, well, ideally what I want to do is compare all of them Australia-wide so that I know which one is the best, or at least according to what I believed. And so I combined my skills in IT with my experience in property investing, and started acquiring data from around Australia and put together that algo.
And I guess what would qualify you to give the advice or this data? Because people are potentially looking to build $1 million portfolios. Like, what's your background? Like,
I don't have any background in data science. I know how to code. I can code in Python. I know enough about data science to get myself in real trouble. But I think, it was experience in property. So my background is electrical engineering, IT, but it was from spending a lot of time buying those 16 investment properties where I've got that sort of on-the-ground background info. So I knew what I was looking for. I just didn't know the correct way to put it all together, like you would if you were a data scientist, for example. So, I guess it was not artificial intelligence. It was human intelligence to begin with.
Yeah, I know you used the Heathcote, New South Wales example at the time when you were looking, because the agents weren't coming back to you because the DSR score was high, but you weren't getting calls back because properties were moving. But then was it Airlie Beach or something you mentioned where they were going to fly you there?
That's
right. The red carpet.
Yeah, so the first time I gathered this data for every suburb in Australia, Airlie Beach units were at the bottom of the score. Like you rank Australian suburbs by this score. Airlie Beach units back then, it was January 2010, and units had the lowest score. And so I just wanted to do a sanity check. I rang a few of the real estate agents in Airlie Beach, and they picked up the phone straight away. It didn't go to voicemail, and they were very pleased to hear from me, and wanted me to come up there. They were going to roll out the red carpet. They said, Jeremy, there's so much to choose from. And I started thinking, it has picked an oversupplied market. Then I looked at the other extreme, which back then was Heathcote Houses. That's in the Sutherland Shire in Sydney. And it had the highest DSR back then. And so I rang up a few agents. One of them got back to me and said, we'll put you on the list and let you know when something becomes available. And so I realised, they're treating me like dirt because they've got more buyers than they have sellers, and demand exceeds supply. So, that was a good sanity test that it works.
And I guess, are there certain indicators that you think, as I mentioned before, have more weighting? So I think a big one for me and a lot of listeners and viewers would be yield, because we know what the rent is. We know we can work out the cash flows for the property. Yield to me is a big one. So I guess there's two parts to it. Is rent growth a lead indicator to capital growth, do you think? That's the first question.
It could be, or it could be the other way, that capital growth pulls up rent. But when you think about the agility of the two prevailing forces in the market that investors are interested in, it's buyers and it's renters. So we want to appeal to renters. We want to follow where the demand is by renters, and we want to follow where the demand is by buyers. So buyers could get into a market first, or it could be renters. So it's much easier to get a lease than it is to get a mortgage. So theoretically, renters are far more agile than buyers. So you could see an area become attractive, the yield goes up, and then buyers come in later, including investors attracted by the yield. So sometimes yield can be a precursor to capital growth, but there are other times when it's just following capital growth. But another interesting point is that a lot of people talk about, we know the yield now. Capital growth is speculative. Who knows how much capital growth is going to happen? But I know I can get a tenant in this apartment or whatever it is, paying $400 a week. The problem there is you don't know if they're going to keep paying $400 a week. You still need to forecast the vacancy rate for that property market, and if there's oversupply, then could come end of the lease and you might have to lower your rent, or there could be a high vacancy rate period. So it's still just as speculative as capital growth.
But you could mitigate that risk. So a way that I would think about mitigating that risk is looking around those surrounding areas would be one. If it's maybe a unit market potentially with oversupply, how many units are coming on, and are you seeing potentially vacancy rates or maybe stock on market increasing in those certain areas? So it's a little bit more fiddly, but you can negate risks. That's what it's all about.
Yeah, researching the data as best you can to make an informed decision.
And I love this because how many conversations have we had years and years ago and we're like, oh, this would be great for an episode, and now it's actually happening. I have to pinch myself sometimes, but I'm glad that we're here. And look, is it a perfect science, and is it 100% accurate?
Yes, it's 100% accurate. No, of course not. Yeah, there are some fails. There are some embarrassing fails, but it's better than the sort of guesswork that we had in the past. So the old school buyer's agent that used to read tea leaves or tarot cards, their best guess was sometimes horribly wrong. And over the years, the DSR has certainly outperformed a lot of the fake experts out there. So it's better than nothing, and things are improving. Here we are really in the dawn of the data age. So the application of AI to property investing is still relatively new. It's still improving, but already it's certainly better than relying on your own gut feel.
I think it's a great way to sort of shortlist, but for me, it does increase probability, and it's not perfect, but we're trying to get it as good as possible. And that's what we're working really hard on at the moment, aren't we? Hopefully next 12 to 24 months, we can just get more and more data. So now, what if an area has a high demand to supply ratio? Does that mean it's going to have growth the next 5 years or 10 years or 3 years? Because for me, it's just short term, really, isn't it?
It is, yeah. It's very hard to forecast out past more than 4 or 5 years. It really loses reliability or accuracy. And markets tend to balance out. When there's an imbalance in supply and demand, they do balance out relatively quickly. So historically, I've noticed it's around about a 3-year window where the demand to supply ratio has picked a winner. After about 3 years, the growth sort of returns to what would be more ordinary, standard, normal for that area.
Yeah, for me, you know that I like to sort of look at those clusters, and I remember back in the day, like I said, I think Hobart was a clear example where all the data was pointing to Hobart. And at the time I couldn't get lending, but it had that increase. I'm like, okay, this actually works. And another one was Adelaide. Same thing, skyrocketed. And then the other one was most probably Brisbane, but it took a little bit of time. Brisbane had a high DSR for a while, but it wasn't really pushing. And I would ask you a lot, Jez, why isn't Brisbane moving? It was sort of there, but it wasn't.
Yeah, there was pressure. Sometimes it just takes a little bit longer, especially if I remember Perth. We had the whole fallout of the resources sector, and Perth property prices went down. And then Perth started looking more attractive, but of course investors and home buyers are still nervous because of the history of the past. And yeah, sometimes it just takes a little bit of time for that pressure to mount before you start to see prices rise. And in Brisbane's case, it was quiet for about a decade before it then started to take off again.
And look, I don't know if you want to be open about this, and you don't need to be, but I guess supply, like you look at the data and we can look at things like maybe stock on market percentage as an example, but how about future supply in a market? Like where can we find that? You don't need to share it. This is me just coming off the cuff. But
oh, okay. So you're talking about like development applications, things like that. Yeah,
correct.
Yeah. So my approach there is to just buy a house in a built-up area because you can't have too much oversupply there. Units are a problem because they can spring up anywhere, and vacant land's a problem as well because that can be developed. If you're going to hold long-term, that will be developed sooner or later. So you can look at development applications, but let's say you do some exhaustive research on this council's website, you find that there are no development applications, you buy a property, and then the next day a development application could be lodged for 100 houses. So all that research you've done, you still cannot guarantee what is going to happen in the future unless you buy in a built-up area already, in an established house.
Yeah, because you could look at maybe what ABS data, some council data, but I think let's use maybe a unit as an example. Like you've already purchased an existing unit and you realise you've made a mistake, which I've seen a lot. You buy a unit that hasn't had any growth or very minimal or even negative capital growth. It's like, okay, do you hold on to that property? Do you actually hold on to that property, or do you sell it? Like if there's more supply coming on, do you make a decision to go, you know what, I'm offloading it now?
Yeah, in the past it's been quite a tough decision to make, but now it's a case of, well, you just need to forecast the capital growth for that property. So if you can get some good data on that market, you'll have an idea whether it's about to turn and finally come good, or it's just still bad years ahead of you. So, yeah, sometimes there have been people who have come to us and said, look, I've got this underperforming asset. I've held it for 10 years. It's barely moved. Can I offload it? And we look at the data and think, well, geez, actually, it's about to take off. You should hang on to it. And then there's others, like a unit market, where we think, yeah, it might come good, but there's nothing on the immediate horizon and there's always the risk of more oversupply.
It's a challenge, and it's difficult because it is a pain. You've got to put it on the market, you've got to sell, you've got to rebuy in. It does take that time. So it's not as simple as shares where you can just sell.
And I think it's the attitude too. You've got to get to a point where you can admit you're wrong. Not easy. Not easy.
The other one, and look, you hear a lot of things saying just always hold, but it's not always the case. You always need to be reviewing that property because it's working for you.
Yeah, I think the always hold advice was good advice in a bygone era, but now in the data age where we can forecast, not with 100% reliability, but we at least have an idea, it now makes sense to review what those forecasts are and make a decision based on that rather than just a black and white always hold.
And that's the reason why you sold out of, I think, was it New Zealand, because there wasn't data available. So you bought in and then you sold all those assets.
Yeah, I thought I had some reasonably good intel when I bought, and they did do very well. But then I found getting data out of New Zealand was much more difficult. I had much better data for Australia. I just thought it's too risky not knowing the nature of that market. So, yeah, sold out.
One I'm very interested in is population growth. So we've heard this a lot. We've spoken about it a lot. I know it's going to be on one of our series in the future, but I remember I went to a seminar. Was it back in 2014 or 15? I can't remember. And I know this professional that was doing a speech talked a lot about population growth, go where the population growth is. And I asked the question after the seminar, how do you find population growth? And they just go, just Google the city. I'm like, okay. And then I thought to myself, how does that lead to capital growth? Isn't that potentially an oversupply risk? If there's population, that means there's more supply coming on.
Yeah, exactly. Most people read population, they're thinking in their heads, population growth. Oh, so we've got a queue of people at a gate wanting to get in. That represents demand. But really what happens is a whole bunch of houses are built, people move in, the records are updated, and that was population growth. But the supply has to come first. People don't move into an area, live on the streets, waiting for you to supply them with an investment property they can rent. Instead, they move into an already vacant dwelling. So at the suburb level where investors have to buy, not at the national level, it's more likely population growth is an indicator of supply, not demand.
I think ID Forecast, I think they do something on that. It's been a while since I've had a look at their website, but they talk a little bit about population and where there's going to be potential supply, but it can always change, can't it?
Yeah, I spoke to someone from ID years ago and asked, how do you do these calculations? And they said, we sit down with council, we look at developments, and they were quite clear on this. This is not a survey of what people want. This is a survey of what's going to be developed. So it really was a calculation, a forecast based on supply.
Okay. That's good to know. Now, I guess two parts of investing, the way I look at it is, I guess in the share market, you've got technical and fundamental. So I guess in the property market, I would think that shortlisting suburbs with the DSR is more technical analysis, numbers, data-based.
Yeah.
And fundamental would be maybe what I've heard is on the ground. But not many people talk about technical and fundamental.
That's right. It used to be a very, very commonly spoken term, technical analysis, fundamental analysis. But now I think because of the data age and artificial intelligence, we are putting more trust in the data, in the technical analysis rather than the fundamental. Really, the right word for fundamental used to be guesswork, just gut feel and guesswork.
From my point, it was like you take a plane, go over to whatever suburb it might be, drive around, see if they've what's their lawnmower like, or are their gardens nice and tidy? What cars are they driving?
That's right. Are they wearing Ugg boots and flannelette shirts, or are they wearing power suits?
I'm like, okay, so I've driven around. What now? What do I do? I actually did that. I did it in 2015. Yeah. I was driving around. And I'm like, okay.
I've seen some streets, and then
just confusing.
Yeah. Yeah, that's a good thing about data. It's subjective, it's numerical, so you can easily compare one suburb versus the other using the same benchmark. It's the way to go. Fundamental, actually, I know what they've changed it to. Now they talk about the science and the art.
Oh, the science and the art. Okay, who mentions that?
Oh, I'm not going to mention any names, but I've heard a few people say it's part science, part art. As soon as I hear the art, I think you don't know the science, do you?
How do we know we can trust the data? Because it's a big thing. I know we've mentioned it before. Everyone's got different data sources. There's going to be more players in the property space. How do we know we can trust the data?
Yeah, I don't think you can trust it implicitly. In fact, I don't think I've met a data set that didn't try and lie to me in some way. There's always anomalies, furphies, but I think that the proof is probably in the pudding. So if you've seen some past growth that the data has shown, then you're more inclined to trust it. I believe we're getting to a point where we can't really trust humans anymore, and the data is going to rule the way. I mean, it's an eventuality that we've got to come to terms with. It's just another thing that artificial intelligence is changing about how we live. But back when I started, back in 2010, nobody trusted data, and I had to make it very clear, this is just a shortlisting tool. It just gives you some ideas to research this suburb and that suburb if you needed some to be suggested. Nowadays, it's more a case of, this is what the data says. You try and overlay some of your own intelligence and you're going to undo the algorithm.
Yeah, you get that analysis paralysis, and it's like, where do you start? That's the thing.
Well, yeah, the whole idea of the DSR was to make it easy. Just give them a single score out of 100. People know scores out of 100. 50 is your pass mark, 100's good, 0's bad. So you don't have to look at a whole bunch of data. I've already sort of munged it together. That was the idea behind it. Right. But yeah, after the first version, I still needed to do some cross-checking, dot the I's, cross the T's,
Have you spoken a lot about, I guess, the property clock, and what is the property clock?
The property clock. Okay.
I've heard it a lot.
Yeah, most people will talk about the property clock where some 12 o'clock might be peak of the market and 6 o'clock might be boom, or maybe 3 o'clock is the peak of the market and 9 o'clock is the boom. But it goes around in a cycle. So there'll be booms and busts. You'll see a market start to flatten out after a good surge, and then it has a period of time with no growth, starts to ramp up again, and that sort of thing repeats. And I guess that's why people refer to it as the clock, because it goes round and round in circles.
Who came up with the clock?
Yeah, I don't know.
I'd be interested to know who came up with the property clock.
I
'Cause
know.
it always confused me because everyone seems like they've got clocks, and I'm like, okay, who do you believe? Like, I just had no idea.
Yeah, there's different definitions about what's happening at which hour, and what phase the market is in, and sometimes you'll get trying to marry the demand and supply for each point on the clock is quite difficult, because on the way up, getting to a point of high demand, low supply, you might have the same score out of 100 as on the way down. So yeah, I'm not a huge believer in the clock.
The clock. So I guess the key part to data, and one thing I've done a lot in my time, is monitor a property performance. Just a client might come in, or it could be someone that you talk to and they've held a property that hasn't performed, or it's even gone backwards. So I think we've discussed this earlier in the episode is, okay, demand might be coming, but you can analyze that. You can analyze that market to go, okay, do you take the risk and maybe just hold it a little bit longer, because the data is saying, hey, there's a bit of pressure here on demand versus supply. Let's hold it out for another 12 months or 6 months and just monitor it maybe month to month or every 3 to 6 months.
Yeah, so there's this tendency for all properties and suburbs to grow at the same rate over the long term. It's just that there might be a long wait before it comes good. So there is some sense to hanging on to an underperforming asset if it is about to turn its corner and have its time in the sun. I guess the question then comes down to how long have you got to hang on to the dud before it does come good? It is a tricky question to answer.
Can you make sense of past capital growth? So I think what I'm talking about here is more trends. So if you look at a trend, so maybe an example might be an area hasn't had a lot of capital growth, does that get forecasted into the demand to supply score?
Yeah, there's a metric called the market cycle timing, which looks at historical growth over the last 6 months, year, 2, 3, 4, all the way back to about a decade. And it looks for that that sort of pattern in growth. Is it similar to the pattern just prior to a boom? If so, then it gets a high market cycle timing score, and that's of course rolled into the demand to supply ratio. So yeah, it's quite important. This is a concept most people refer to as mean reversion. So if it's underperformed for a long enough period of time, it's now probably quite affordable compared to the rest of the market. If there's a suburb that's boomed, then it's probably looking unaffordable, and so it's going to have a soft period of growth in the future.
Yeah, no, that's good. Yeah, it was just interesting because it's like, do you want to buy after an area is just significantly grown? But if you say long term, you might just, because I guess the way that can be formulated to you is, hey, this property's been performing at this growth rate. It doesn't mean that it's going to continue to perform at that growth rate moving forward. So just something to be mindful of.
Actually, the complete opposite. Yeah, if it's outperformed over a significant period of time, there's a very good chance it's going to underperform.
Can you rely on one metric alone?
No way. Yeah, I mean, there are metrics that show a correlation to capital growth, but there are so many exceptions where the metric might be a good figure and the growth goes the other way.
Yep.
So it's not until you put together a whole bunch of data and most of the metrics are pointing in the same direction, then that's a good indicator. Interestingly, I've never found a market, even when I only looked at 8 variables, the first version of the demand to supply ratio only had 8 variables, I never found a single market where all 8 variables were above the benchmark, like normal. So you will always find one metric at least that's sort of going the other way. And half the time that could be just an anomaly in the data, which is why you cannot trust an individual metric.
Yeah, I think the statistical reliability metric is most probably really important. How reliable is the data?
Yeah, well, that was another thing. I realised, look, I'm scoring all these suburbs around the country, but some of them are a bit short on data, so I probably want to avoid those. So I had to come up with a measure for statistical reliability, and it mostly comes down to volume. There are a few other things, like if you get data from 2 different sources and they contradict one another, then that lowers confidence. If they both agree with one another, then that raises confidence. But volume's a big one. For example, auction clearance rate, you have one auction in the month. What's the auction clearance rate? Well, it can only be 0 or 100%. But if you have two auctions, then it could be 0, 50% or 100%. So the higher the volume, the better the accuracy, the more reliability you've got.
And how many, again, we've spoken about this a lot, statistics do we want? Like, what do we want to get to?
Oh, well, the more the merrier, unless, of course, they're completely unrelated to capital growth. Yeah, nowadays you have these things called synthetic variables. It's part of the realm of data science called feature engineering, where you may have a base metric and you derive other metrics from it. And sometimes the machine can combine a whole bunch of metrics in a concept that humans might not readily understand, but this combination of metrics has a correlation to capital growth. So there can literally be hundreds and hundreds of metrics.
Do you think that having more statistics can confuse the algorithm or not? Like, is there a point where we think, okay, what is that sweet spot? Because I'm thinking maybe you get it right, and by adding more, maybe when's enough?
Yeah, there is that in data science, this principal component analysis. And look, I'm not a data scientist, so I won't talk on that topic too much, other than to say that the machine can figure out whether it's worthwhile including a variable or ignoring it.
Yeah, okay, that's good. And moving on to, actually, have you ever thought about this maybe data point is income growth? Now, again, we've discussed this a lot, but does it have an impact on capital growth?
Not any of the analysis that I've seen. For decades, income has been higher in eastern suburbs of Sydney, but for decades, the eastern suburbs of Sydney has not always outperformed, say, the western suburbs. So there is not a close enough correlation to capital growth with incomes, high incomes, low incomes, income growth, income relative to the state. I've looked at a few things, and it's not really a good indicator. So it was a nice idea.
Unless someone wants to prove us wrong and send through information to...
Happy to be proven wrong and improve the algorithm.
That's it. So is there... Actually, this is a big one, but is there a lag time in the data? So you've got everyone going to a specific market depending on the price point. Is there a bit of a lag with the data?
Oh, yeah. Depending on the data set, the biggest lagging data sets come from census, because it's only once every 5 years. It can take a year after the census is conducted before the Australian Bureau of Statistics publish a metric, and some of them are even later than a year. So you could be 6 years out of date, worst case scenario. And then you've got other metrics which could have been accumulated last week and they're published this week. So it can be very up to date, or it could lag. But there's nothing that's absolute real time right this instant.
Ones that I guess popped up for me just then is, do you think you can get it to a point where it updates the data every day? So it's like live.
I think at a very large macro geography level you could, because you've got so many transactions taking place Monday to Friday at least. So most auctions happen on the weekend, so you could have those being updated quite frequently, at least weekly. But then you've got Monday to Friday, all these transactions, these properties that settle. So if it's very broad geography like Australia-wide, you could have a daily figure, a daily update for some metrics. But where it's granular, where property investors, we need to buy in one street of one suburb of one postcode of one LGA, it's very localised. At that level, you just don't have the volume of transactions, even in a month, for it to be honestly top reliability.
Yeah, because I think that would be the compromise, wouldn't it? Reliability.
Yeah, there's always this trade-off between higher sample size but a longer period of time, so it lacks currency, recency, up to the minute. But then you try and get too too up to date data, and it lacks sample size and is unreliable from another aspect. So yeah, there's always a trade-off.
Have you seen a market drop month to month? So you've got areas where the scores are really strong, and then yep, great, I'm going to invest in this market, and then next month the DSR score drops significantly.
It certainly has happened, and yeah, it's a little embarrassing when someone says, Jeremy, I've just bought in this location, your DSR's just dropped by 10 points. What I always do is check the volatility of the demand to supply ratio. So I look at it on a historical chart, and if it's bouncing up and down month to month, I think, well, that's a market that doesn't know which way it's going. It might be an unreliable market. Either way, that volatility to me spells unreliable, and so I would steer clear. And I'd always check the latest month. Is it a one-off high, or is it just another month in the same trend that we've seen, and then I can rely on it. But even in those cases, you do find the next month it could dip, but then the month after that it could come back up again. But it's worthwhile looking at historical charts.
That's right. And I think like you said, maybe if it's a specific pocket, like I wouldn't go, okay, this suburb has the highest DSR, I'm going to go invest there now, and it's in the middle of nowhere and it's a one-off. It could be a mistake. Maybe there's a lot of volatility. So it's just, for me, it's a short listing tool that I would use. And then you sort of have a list that you go, okay, great, this meets my criteria in the suburb I want to invest in. Then you can start moving to that property level.
Yeah, if you've got this isolated suburb that you say, yeah, that's a worry. But if there's a suburb nearby, maybe a neighbouring suburb that's also got a high demand and supply ratio, then you've got confirmation that, hey, there's something going on in this area. So, yeah, larger area analysis is helpful. You got
that neighbouring price balance and that ripple effect potential, but I think I'd want to see more than just two. I'd want to see more than that above average DSR.
Yeah, what's the neighbouring suburbs DSR? Yeah.
All right, good episode. Jeremy, yeah, that's when we're just asking you questions.
Did I get them all right?
I don't know. Yeah, I think so.
We'll have to ask Ryan.
We'll have to ask Ryan. But yeah, I guess just closing thoughts is, this is just one part of the analysis, and we want to make, I guess, more and more data. That's what we want to be about moving forward.
Yeah, improving the algorithm, improving the reliability. Yeah, more data. More data.
So where can listeners go for, I guess, more resources?
Well, you can subscribe if this is of interest to you and you're hungry to devour more. You can click on like to let us know if this is the sort of thing that you're interested in, and we'd love to hear your comments too. Yeah. And if you think this is of interest to someone else, there's a share link too.
Great. So look, thanks for tuning in, and see you in our next episode. Bye for now and take care.